Good morning, good afternoon, good evening, traders. I'm very excited to speak with you once again. I want to continue this series of having you understand properly market structure. I want you to have you understand market structure. You know, I've been hammering on this because I believe this form foundation of trading activities, irrespective of the system you are trading. Market structure form a key to your success. I keep on telling my students that I have not seen how good a trading system will be or a trading strategy will be where a buy trade will be taken in the supply, in the resistance, or a sell trade will be taken in support. It's not just possible. So because of that, I want to try as much as possible, to detail out market structure at different level to my students. When I say at different level, what do I mean? At part 1 of understanding market structure, I try to x-ray what market structure is all about in terms of the behavior, in terms of the trend, in terms of the swing highs, in terms of the swing lows, in terms of the supports, and in terms of the resistance. These are key concepts that you must understand before you can absolutely understand market structure. I move from there to part 2, where I discuss with you the market nature, that for you to understand market structure properly, you must understand market nature, because each time market is forming a trend, let's say for instance, market is forming an uptrend, there is usually a push of price to break the structure. Okay, for a resistance to be broken, there must be a push of price to the upside to break it. And I also told you in that part 2 that the vertical axis of the chart is the price, while the horizontal axis is the time. So in an impulse or in an impulsive wave, I told you that market break the structure very strongly. But then I also warn you in that video, especially to those traders who are fond of trading breakout, that each time market break a resistance, even if it's with 5 or 6 pips, it has broken a structure. And there is no rule up till now that defines how far this break should take place. It can get here and come down, all right? It can also come, break to this level and come down. So since you are not sure with high degree of certainty the level it will get to before it turns, then taking a buy trade at a break of resistance at this level is not just right, because it might just give you a few pips and now turn back. Then what's the right thing to do? Allow the market to turn back, let it retrace back to this level. Most time, this resistance here, the market will come there, form a support, and then proceed to the upside. But I don't usually teach breaking of resistance and retest as support, because many a times, many of you will be waiting for this resistance here to be tested and support to move. It will never come there before it will move. And sometimes it will get there and come further before it moves. So which one will you take? How will you know? That is why I'm not a fan of break of resistance to turn to support. There are certain things you look at to know the appropriate level where it will turn to the upside. These are things that we discuss. We also, in part 2, we also discuss corrective structure. All right, that every pullback in a strong push to the upside constitute what is called correction. If you have a push here, you must have a correction. You have another push that break the structure, you have a correction. You have another push that break the correction. I also made it clear to you in that video that each of these push that you see here also come with its own swing, with its own swing. It is very important you understand, even this pullback have its own swing. All right, break it here and correct, you know, break, correct, break, correct, break, correct. Each one here has its own swing. I made it clear for you in that video. But now we are going to move a bit further in this part 3, a video of understanding market structure. We'll be looking at reversals at the top and at the end, at the top and at the end of uptrend, and bottom at the end of downtrend. How to trade them and possible ways to avoid being trapped. Okay, I keep telling you, I've trained a little more than 1,000 students. I've interacted with them. I've known how how they take their trades. I have known the major constraints they have. So I am in the best position to tell you what works, what don't work, what you should be doing, what you should not be doing, the habit you should reject, the one you should imbibe. I am in the best position to tell you because I've done a lot of research across board, and I know what is, what is trending in the market, and what you should reject and what you should accept. But first and foremost, I want us to look at uptrend. First, I want us to look at uptrend. So, and in an uptrend, let me just clear this board. Let me draw it for you. In an uptrend, you have something like this. You have a consistent formation of higher high, higher low. This low here is higher than this low. You have a higher high because this high is higher than this high. Then it comes back from a lower high, a higher high, a lower high. Then it gets to this place. All right. Price can no longer make a higher high. When price can no longer make a higher high, it's a signal that we may not be going upside. We may have to start looking for downside. All right. This is a signal. But at this stage, I'm going to teach you how to find out in the first place. If even at this level here, when this one was here, I want to tell you how you carry out a check, a diagnostic check. I keep telling you, just as lawyers will interrogate their clients to know how truthful they are about the claim, about the brief, and all those things. Medical doctors will also carry out, a diagnostic check on their patients to know the best treatment to administer. So this happens in every profession, every profession. You see a building engineer, we want to look at the tensile strength and the likes of the rod they want to use. They want to examine the trend to know where they want to examine the strength of, of the iron they want to use in their concrete, so as to be able to, know whether that size of iron and the strength of iron will fit in to the structure that they want to build. So it happens across board. So trading financial instrument and analyzing the chart is not an exception to this rule. We also have a lot of diagnostic check we put in place to ensure that we are right about what we are doing. And if up till now, as a trader, you do not have the proper understanding of this diagnostic check and how to apply them, then you have not started. It's just as good as you graduated as a medical doctor, you're already practicing, but somebody comes with, a brain damage, and you are telling us that you don't know the right test to be conducted before that surgery can be performed. Then we'll tell you to go back to medical school. Do you understand? The same thing as is applicable in forex trading. We carry out a check. So at this stage, I want to show you the check that we conduct for us to know that this downside is imminent. And that check is done with the aid of a divergence. And I've told you in the past that divergence is taken between two levels of impulses. All right. Of course, you know, at this level, I don't need to be telling you what an impulse is all about, what a correction is all about, because you have already done them in part 2 of understanding market structure. Now, this part 3, you are no longer studying impulses and correction. You already know them. So now, this is a push, which is an impulse. This is another push, which is an impulse. Between this push and this push, we want to find out whether there is divergence between them. First and foremost, what do you mean by divergence? Because I know many people will be confused because they may not have heard divergence before. Divergence is a disparity in direction between your chart and your indicator. Disparity in what? In direction between your chart and your indicator. For instance, if your chart is making a higher high and your indicator is making a lower low, you know that there is what? A divergence. Meaning that there's not going to be immediate turning, immediate reversal, but a divergence will signal that reversal is likely. Reversal is likely. For instance, I will show you here. You see, this is a push to the upside. This is another push to the upside. We want to see the end of this push, which is here, and the end of this push, which is here. We want to find out it has made a higher high. So we want to come to the indicator, and the indicator that I use is RSI. Okay, if RSI is like this, we want to see see this point here. Okay, want to see this. Can you see? At this point now, let's assume you have it this way. Perfect. You have it this way. Perfect. In such a way that you see this horizontal level here, this vertical level here correspond to here, and then this another vertical level here correspond to this place. All right. So you see that here we have plugged from here, from low to high of the last two impulses. But when you come to the indicator, you're not going to get it that way. What I'm going to get is here from high to low. Okay, can you see that as we are making a higher high here, we are expecting the indicator to also give us a higher high. But in this scenario, it's not giving us a higher high, rather it's giving us a lower high. Okay, now let me interpret what this means to you. What it means is that you have a push here, which make a high. You have a push here. But here, we even have a greater push in our own understanding. Because if this push is not a greater push, how come that it broke this resistance? How come that it broke this ceiling? It was a greater push. But if you come to the indicator is not giving a greater push. It's giving a lesser push, which means even though on the chart, it's looking as if the indicator is looking as if the chart is having a greater push to the upside. But then right here on the indicator, which measures the overall strength and movement of this pair, what we are seeing is what? A lesser push, which means that there is going to be an imminent breakdown to the downside. We are expecting an imminent breakdown to the downside. And now can you see when this market comes and make a higher low here, when this higher high is coming, when we're expecting this to come, make this higher high here to break this top, it cannot break this top. It remains at the same level. Okay, this is a signal that we may be going down. But is that enough reason for you to get into this trade? No, you are not supposed to get into this trade. You are supposed to wait to see this level of support. This last support here must be broken. All right, this last support here must be broken. As soon as this last support is broken, yeah, now you are in to look for a continuation trade. How do you look for a continuation trade? You must look for a pullback of this leg to the upside. You can use a fib You can use a fib to get the level here, to get the fib level here. So between 50 to 61.8, you can look for opportunity to sell to the downside. Then at times, you can also get something like this after this market has broken this structure. Sometimes you can also get a structure that look like this. You can get a move up. You can get corrective structure at this level, corrective structure at this level. It can even break down, pick liquidity here, grab it, take it to the top, break this top here, and then it'll come right straight to the downside here, forming a corrective structure, and then further. So you've got to know how to play with this structure. What will give you idea of what the pair is doing is your consolidation level. Is your consolidation level right here, guys, right here. All this will give you idea of where you are going in the market. When you are reading the overall structure of the market and you are seeing the level the market is consolidating, you should be able to decide, based on your experience, trading the market, you should be able to decide whether the market is going to the upside or to the downside. So you must be ready to carry out some of these structural examination to test potential reversal, with divergence. So if there are divergence between two tests, between two last push to the upside, then you know that after the first break of last support to the downside, we start to look for sell opportunity. Are you okay now? Are you getting it now? So at this point, you begin to notice what we call change of character from bullish to bearish, market structure. You will notice what is called change of character from bullish to bearish. You see that market was forming higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high. This time around, not higher low, but what? What is it for me? Lower high, lower low rather. Because this is a low, this is a low, but this low is lower than this low. So this is a lower low. So now, if this comes to this area, you can see that here, this place, this swing is lower than this swing. So this is a high, and this is what? A lower high. This is a lower high. So this is a high, this is a high, but this high is lower than this one. That's why this one is called lower high. So this is lower low, lower low. Then this one will now be, this swing point will now be a lower low. All right, like this, from a lower low, lower low. Lower high here, lower low, this lower low. Can you see? So there's a change of character, bullish to what? To bearish. So you should know how to play with it at the top here, right? That's how to treat reversal. All right. So you must be careful. You must remember divergent text in three-wave pullback. You must know this, because I made up my mind that I'm going to teach you how to carry out this divergence diagnostic test on your chart. Now, let me show you an example. You must be careful at applying, this test in your chart. I'm going to show you something real quick. If you have this higher high, higher high, higher low, higher high, higher low, higher high, then a situation can arise where you have this, and you have a continuation move to the upside. All right, and the situation can also arise where you have this, 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 this. This chart look very similar, but there are ways you will apply divergent test to diagnose these two charts, to know whether this one is going to move to the upside or this one is going to correct and push more to the downside. Now, I'm going to show you. You come here, you already know how to, apply divergence, assuming you have your RSI like this, and in this scenario here, you have, you have these two pushes, this push down here, and this push down here. Here you have these two pushes, you have push down here, and you have push down here. What I mean by push down is this: you have this push down, you have another push down. This is how to measure divergence. You have this push down, and you have another push down here, guys. So now, on your RSI here, if you have a situation where you can see that on the chart first, you see this chart is making a lower low. This is a lower, this is a low, this is a lower low. Is that okay? Now, on this indicator here, for this pair to break to the upside, for us to expect upside and never to think of any more downside at this level, there is something we will check on the indicator. If the indicator is giving us, it's a lower low, if it's giving us a higher low, all right, what are we saying? It's supposed to be to the downside. Sorry, just hold on. Supposed to be here, yeah, supposed to be here. So now let's adjust this to fitting. All right, so let's grab our vertical line tools here, grab the second one here. Do you know what I've done now? What I've done now is just simple. I want to fit in the swing point here of this push to the downside, the swing point of this push to the downside. Look at it here. Swing points here represented on the indicator here and here. Do you notice something? This market here is making, a lower low here. But what we see on the two swings here is making a lower high. Can you see? Look at the interpretation. Look at the push here. It's very small. Look at it here. Big. Look at this push here. It's greater than this push here. This push here look greater, look more impulsive than this push here. But on the indicator that is measuring the actual strength of the push is telling us that this second push here may be looking longer and faster in our own eye, but in the real term, it is not as greater, meaning that the liquidity that is pushing this market down here is actually very low compared to what you have here. So if this liquidity that is pushing it down is actually very low compared to what you have here, then there's divergence. There's divergence because there's divergence in the sense that there's disparity in direction of flow between the indicator and the real chart and the price. Price is making a lower low here. The indicator is really making a higher low. So based on this, we know that this market is going to push to the upside, which is what you see here. But now let's do the same thing here real quick, guys. Let's do the same thing here real quick, guys. Let's do the same thing here real quick. Can you see, guys? Yeah. Look at it here, guys. Let's grab our vertical line tools. Let's grab it here. Yeah, let's move this indicator right here real quick, guys. I have to draw it again. It has to fit in. Right, it has to fit in. It has to fit in. It has to fit in. Okay, so grab these two here. Boom. Here, correct. Can you see here? Guys, can you see? This is a push, this is another push. We want to measure at the end of the two pushes. We want to measure divergence. Can you see from here to here, making a lower low on the price, but here and here is also making a lower low. This one was making a higher low, but this one is making a lower low. So there is no divergence between price here and the indicator. So for that reason, we are expecting this market to continue a flow to the downside. All right, meaning that after this push here, we're expecting a correction here and will now continue to sell to the downside. Why? Because there is same flow between the price and the indicator. And this is actually how I conduct fake flag test. Fake flag test, because in real chart situation, this is going to form a flag this way, a flag. And when you see a flag like this, you are tempted to what? To buy this to the upside. You are tempted to buy this way to the upside. But because of the diagnostic check on this chart to know whether there is divergence or convergence, and in this case, we are seeing a convergence, we know that this move to the upside is not going to take place. It's rather going to correct at this level when you see that you have moved up to 50 to 61.8% of this move. You are going to find a way to get it, especially at the early part of New York session. You get in for a sell to the downside. Okay, so now this is the same techniques we are going to use when the uptrend is over. This is the same techniques we are going to use to catch your trade to the downside. Not coming to this level and try to pick the top here. No, you don't trade that way, guys. Don't trade that way. Don't try to pick the top and bottom. It can be very disastrous, and you can kill your entire account as a result of that bad habit. Okay, so we now know that in a situation where the market is giving you this push like this, where's this two? The situation where the market is giving you this push like this and giving you this correction to move up. What is it telling you? It means that the trend is not over here. This is not a reversal. It means that this move here is not a reversal. It is only a pullback. This is not a reversal. It is a pullback. This is how we know by using divergence. But in this case, where lower low is made here, and on the indicator, you also have a lower low here. So this one is telling us that there is a reversal. In that case, after you made this three-wave structure correction, you have to look for a corrective structure here, pull to the upside and break down again. Do you understand now? So this will continue to break down, as long as the convergence is there, which support a move to the upside. All right. So this is how you look at it. So I've crafted out three rules. I've crafted out about 4 rules that I use to trade reversal after the end of an uptrend or after the end of a downtrend. You don't trade by picking the top and pick the bottom. There are essential rules you must follow in order to be able to appropriately do this. Rule number one is that firstly, you must wait to ascertain that you are on a reversal zone, whether at supply or at demand. You must wait to see that you are truly at reversal zone. How do you know that you are truly at a reversal zone? This is where your knowledge on time frame analysis must be there. Assuming you have put this market on daily, and on daily, you see that you are at the bottom. Okay, you are at the bottom here, and you move on the daily, you come to this area of resistance here. You have moved so far, it's completing this swing. Now, you are expecting either a reversal or a pullback. You are expecting either a reversal or a pullback. So now, this is the area of supply where you'll be expecting a reversal. Now, the first rule says that you must ascertain that a reversal will take place. How do you ascertain that a reversal will take place? It's the first thing we did the other time by carrying out a diagnostic check between this push to the upside and push to the upside. Is there a divergence? If there is divergence between these pushes, here, this swing here, and this swing here, if you check your indicator and you are getting something like this, meaning that this one is making a higher high here, this one is making a lower high here. So there is divergence. So this check that we have carried out here give us, peace of mind that this market is going to get ready to fall. That is the first thing you must check in the time frame you are trading, either 4 hours time frame or 1 hour time frame or daily time frame or weekly time frame, depending on the type of trader you are, whether you are a swing trader or you are a day trader or you are a position trader. That will determine the time frame you are going to use for your analysis. So that's rule 1. You must ascertain reversal. You don't ascertain reversal by mere looking. You have to carry out check on the reversal pattern that is before you. Of course, you must also see that the structure is not making a higher high. Again, after you have carried out this, you remember that this diagnostic check you are carrying out is only when the market is at this level. That's when you carry out the check. You see that there's going to be a potential reversal. Now the market comes down, make a higher low, and when it's to make a higher high, it cannot break this top. This will confirm the diagnostic check you have put in place by using your divergence. This lack of momentum to break this top has confirmed it. And in that case, you are looking for, the next rule that you follow in order to pick your trade at the top or at the bottom. Secondly, wait to see structure not able to make higher highs or lower lows. Can you see this structure? This second structure cannot break this area to make a higher highs. The same thing is applicable in a downtrend. Somebody will say we have not been using downtrend as an example. All of us want to be going higher, 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 and higher. All right, that's just the issue. It's easier to draw to work with downtrend than uptrend. Can you see? Break here, move, and move. You see, this is an example in a what? In a downtrend. You can see it's the same thing that we draw here that is also here. All right, you see all the swing points, you see them, see them. It's just the same thing. The same thing here. Rule number 2, I say check to see that this is not able to break this structure. It's not able to break this structure. As you go higher in understanding structure, understanding liquidity, you get to understand that even as it's not able to break it to make a higher, a lower low, most of the time when you are looking at the structure, you might have a consolidation here before this low, and this break to the downside will just come, break this level here. It's still making an equal low, but it's only coming here to grab liquidity. All right, and as soon as it grabs this liquidity, the market will move to the upside. This is where many retail traders, lose out in this game. This is just the minor difference. Minor difference is liquidity. Understanding where liquidity lies in the market understanding where smart money are getting in, where the banks are getting in. That's just what we need in this market. So we have seen the first rule. The first rule is that you must apply divergence to know that there is going to be an end to what? To uptrend or an end to downtrend. Secondly, you must see that the last structure that formed cannot break the previous top, as in this case, or cannot break the previous, the last bottom. You must see that. And thirdly, you must wait to see what is called liquidity graph happening at supply or resistance, or happening at demand and support. You must wait to see liquidity graph. How do I mean when I say liquidity graph? Let me explain with this. Let me clear it and explain again. For instance, let's use downtrend this time around. See, market is forming consistent formation of lower low and lower highs, lower low, lower high. At this level now, market cannot break this structure, but on getting to this level, you see some measure of consolidation here. As soon as we see this consolidation here, this market is going to break down this low, peak liquidity. You see, is T at equal low. All these lows are equal to this one, but this breakdown to the low here, I just come to peak liquidity, and it's going to fly up straight on, correction and go. You understand? So at the end of a downtrend, or at the end of uptrend, you want to see a structure like this that actually grab liquidity. Of recent, I don't trade a setup that have not grabbed liquidity, because the essence of me waiting to see liquidity grab is to ensure that market is not going to find any incentive to return to where it's coming from. For instance, if this market here has peak liquidity at this level, all right, and it has moved away very fast, there is no reason why this market must pull back and come to this level. No way. What it can do is to correct to a reasonable level here, and what? And push to the upside. So it's as simple as that. That is the third rule. You must ensure that there is liquidity grab at demand in the case of end of a downtrend when you have to buy, or liquidity grab at supply in the case of what? Of an uptrend. If an uptrend is going like this, and when you're supposed to make this higher high here, the market is just consolidating here, then what you should expect at this stage is this market breaking this equal top here to the upside to grab liquidity at supply. All these are here. This is the supply. Can you see? Can you see this move to the downside is very sharp? Can you see? Can you see this? Can you see this? Okay, so you should expect that this market is going to grab liquidity right here, guys, right here. After this consolidation, it's going to grab liquidity right here. And as soon as they grab it, this is the supply that I was telling you. Grabbing liquidity at supply. This is supply level. Here, grabbing liquidity right at demand level. Start grabbing it. What does it do? Straight move to the downside. Is that okay now? That is the third rule. It must develop consolidation, a well-formed consolidation, and a push to grab liquidity, and a flush to the opposite direction. Fourthly, check the session where you get the big liquidity. You must check this, you must check the session where you get the liquidity to ascertain if such amount of volume available in that session is adequate to result in what? In continuous flow of the market price. All right. So in this case now, in this down post now, I want to see that this pair, when am I getting this push to the downside to catch this liquidity? If I'm getting it at London session, all right, I'll be very happy to wait here to see that this New York session will push me to the upside, because I know fully that London session reacts so quickly to problem created in consolidation market of Asian session. It reacts quickly to breaking top, breaking bottom. All right. So if I see that, gently is breaking this bottom here, I will look for buy opportunity in New York here to the upside. All right. So those are the 4 rules I follow in order to pick my top and to pick my bottom. Let me repeat the rules again. Number 1, I try to ascertain that there is potential reversal coming. And how do I know that potential reversal is coming? I want to use, the resistance. I want to use divergence to check that. All right. After that, rule number 2. Secondly, I want to wait to see structure not being able to make a higher highs in the case of an uptrend, or to make a lower low in the case of a downtrend. That is rule number 2. Then rule number 3 is that I want to wait to see liquidity graph at the reversal zone. I want to tell you the secret today. Banks, the primary liquidity providers like JP Morgan, like Morgan Stanley, and so on and so forth. These big institutions, they don't trade everywhere. They are waiting for this end of trend area up here or big here. This is where they want to trade. And what are they looking out for? When this consolidation is happening and this market is breaking down, all of you retail traders, you are already selling, because you say, what do you say? You say this is a downtrend. But Morgan Stanley, JP Morgan, all these investment institutions, they are not seeing the market like that. They are seeing a situation where this liquidity, where this market break down to the low, peak liquidity at demand here. This is where their order reside. Okay, from here they will pick the order and then they move straight up to the upside. So what happened? You that is selling here, what happened to your stop loss? Your stop loss is hit. You are out of the market. So you must be able to articulate this rule and trade smartly. It's not about how many trades you enter in a day, in a week. If you have only 3 trades in a month, and these 3 trades in a month give you 5% or 10% of your capital, it's good for you. And I'm sending this note of warning here that, guys, don't be trading too much. Don't be trading too hard. It is better you get smarter with knowledge than you get, harder with the energy you use in trading. There's no point displaying too much energy. Who are you fighting with? You don't even need muscle to trade the financial market. You just need to be smart. Be smart. Try to educate yourself, equip yourself with adequate financial education that will enable you to be able to articulate all necessary rules together and play by the rule of the game. All right. So observing these rules above will definitely make you to be on top of the game, no doubt. So if this video has really provided you with valuable knowledge, that will help you, then don't hesitate to subscribe to this channel, and if you have already subscribed to it, that's good. But make sure subscription is not just enough. You must press notification bell so that anytime my video drop, you are going to be the first to see it. Well, if you press notification bell, good for you. If you subscribe, good for all of us. But again, you must comment. You must comment. You should share. Share the video, comment on the video. Let me know in the comment section any topic you want me to do a video on. I will be glad to do it for you. All right, so that all of us will learn and grow together. I will be glad, certainly. Just put it on the session, on the comment section. Please do me a video, explaining so stuff. Do me a video explaining so stuff. I will gladly do it. All right. Without wasting much of our time, I don't want this last video to be too long. That is very vital, because if you understand market structure, you understand everything, but you don't understand the behavior of price at the entry point, then you will still miss up everything. And this trick, and especially these 4 rules I've crafted for you, is what the banks follows to trade. And I'm just showing you the levels bank get involved in the trade. All right. So please master the market structure. Other videos will be dropping in this channel. I'm going to make this channel very interactive. I'm going to give you a lot of setup. You know, 80 to 90% of the setup I give is very super. All right. So see you in next video. Peace.